Hi, today I'm making a video on a super important topic if you're an active trader in any kind of market, whether it's traditional and maybe even more so if it's crypto, and that's market making. So my name is Justin Danathan. I've worked at a few different market making firms, and even before that I was working at a crypto exchange that would then cater to or try to attract crypto market makers themselves. In this video, we're going to talk about why market makers exist, and then of course how they operate, what the risks and what the profit or the reward might be. The very first concept you need to understand is liquidity, or the absence of liquidity, like a market that would be illiquid. And that's a term that you should hear a lot if you talk to any kind of sophisticated trader, trading entity, exchange, token project that has a token that is live and that has, active markets. Everybody cares about whether a market is liquid or illiquid. And what that means is how easy it is to buy or sell. So essentially how easy it is to trade a certain asset, right? So if you're speculating, if you're investing, you want it to be easy to enter and exit an investment. And that has two factors. The first one is it done at a fair price? Am I getting the price that I think I should be getting for that asset? And can I do it in size, which is essentially maybe jargon for just saying, is it in the amount that I would want it to be in? If it is, then that market is liquid. If it is not, that market is illiquid. So we're going to go over an order book to kind of show you how that translates into the real world. And once you've understood liquidity and illiquidity, you will totally understand what market makers do or their raison d'etre, their reason for existing, the value add they have in the space, right? So again, I'll repeat quickly the definition. If you're in a market where you can get the asset at a fair price and in size, then it is liquid. If you want to buy Bitcoin at 60K and you can't buy it at 60K for whatever amount you wanted to buy in, that is a liquid market for you. If for whatever reason on the platform you're trading on, you cannot get it at that price, a bit lower, it's a bit higher, or you can't get it for the amount that you want at that price, then it's an illiquid market. I will show you in 10 seconds what an order book looks like, and then I'll show you what an actual order book looks like, and we can kind of look at it in more detail. An order book is very simply composed of four components. The first one, the main one, is about the mid price. And the mid price is essentially what you're seeing when you're looking at a quote for any kind of asset. So if Amazon shares are trading at 1,000, that's essentially what they're showing you, that mid price. If you see Bitcoin trading 30K for whatever reason, that the mid price is 30K. And then you've got the bid price, which is the first price at which people are willing to buy at. And so if you were a seller, that's the price you'd be interacting with. You're selling to the first person who's willing to buy from you. And the ask price is the first price where people are willing to sell. And so if you're a buyer, you're interacting with that higher price, with the first price at which someone is willing to sell. The fourth component we're going to see in the actual order book is the amount that is available at each side. So before I go through this order book and kind of the different components, I want you to ask yourself, do you think that order book is liquid or illiquid? If you've guessed illiquid, you're right. I specifically chose that order book because it is illiquid. It's a very liquid market. Let's look at why that is and go back to the definition that I was talking about earlier when I was talking about liquidity versus illiquidity. You see that the mid price, presumably the fair price of this asset, is 0.00747. Can you buy it or sell it at that price? The answer is, of course, you cannot. The first price at which you can sell, for example, is 733, which is quite a distance away from the 747. That's the first willing buyer. And if you look further on the right, you can see that the amount they're willing to buy is about $10. So if you wanted to sell, for example, $400 worth of that asset, you would interact with a price that is already far away from that mid price, it's 733, and you would only get $10. And then your order would go through to the next willing buyer, which is 726, a further distance away from 747 for $25. So now you're filled for $35 and you still have $365 to go, right? So you'd go to the next order, 719, even further away from the mid price, and then 712, even further from the mid price, and so on and so on. So the average price at which you've sold is actually much lower than the mid price that you were looking at. And depending on what the order book looks like, you can't even fully get filled. Although here you just eventually get filled at that 999 order. And of course, it works the exact same way if you wanted to buy, right? If you wanted to buy, you can't buy it at 747. The first price you can interact with is 750. And here you can do it for 364, which is still not the full order that you wanted to go for, but it's a bigger amount. But then you go to the next level, which is 754, further away from the mid price for $25, and then 761, even further from the mid price for $25, and so on. Quick parenthesis. For some people who are already looking at the amounts here, you might notice something strange. 2577, 2577, 2577, and then here below 2577, 2577, and so on. That's a market maker in the order book. We're not even going to go into it because that's not the point of this particular slide, but it's interesting to see that it's there. And so they're essentially posting on either side of the order book, on the buy side and the sell side, in like quite symmetrical amounts just to maintain a certain spread. But so here's an illiquid order book. You kind of get it, right? You can't fill your full order at the price that you would want to. We're going to have just a quick last example with this slide. We're showing you the exact same order book, and you can see what a liquid order book should look like and what an illiquid order book looks like on the right. It's pretty obvious, right? Here, the mid price is essentially already there. Whether you're buying or selling, you're getting it for essentially the same price, 99.9 or 100. And you can do it with, there's different amounts, but let's say you wanted to buy 40 units of that asset, you would buy 40 here, and you wouldn't even move the price. You wouldn't even push the price high. You would get your full order filled in at 100. Or if you wanted to sell 40, you could fill that full order on that first buyer, 99.9, and you're very happy with the price. It's kind of very much in line with the mid price, which is 99.999, I guess. Here, you can see immediately that the difference between the best bid, the first willing buyer, and the best ask, the first willing seller, is actually quite wide. So there's 99.7, but in between there's 99.8, 0.9, and then 100, 0.1, 100.2, 100.3, 4, 5, 6, and so on, all the way to 101.2. So the difference between the best bid and ask, the spread, is actually quite wide. And then you can see immediately that the amounts at each level is not as liquid as the other order book. So if you wanted to buy 40, for example, of that asset, you would get filled for 10 at 101.2, but then you need to go to the next willing seller to get filled 5 additional ones. So now you're at 15, 102.6, and then an additional 10 at 103.1, and then you would finally fill your full 40 order at 105.2, and you would have like 2, you would leave the order book with 2 remaining on that order. But so the average price here is much higher. You bought at a much more expensive price than if you filled here at 40 at 100. That's essentially the whole point when we're talking about liquidity and illiquidity. How easy is it to get your full order, your full trade done, price that is as competitive as possible? It's much better to buy at 100 than to buy at 102.75 or whatever the average price of that trade would be. You can see this more visually on this order book. So it's exactly the example that I'm giving illustrated. Here you bought 40 and you haven't moved the price and you're still leaving 20 at that level in that order book. Here you bought 40 and you plowed through the order book, so you move the price up, and so your total price that you acquired this asset at is not as efficient as you would want it to. It's not as competitive as you want it to. So here we go. Let's kind of pin down on the problem, and then I'll actually talk about market making and market makers, and it will all make sense to you. If prices are not fair, so they're not in line with the main market, if the amounts are not large enough, and so if essentially the prices are too volatile, meaning that your orders push the price up or could push the price down because there's not enough amount and enough inventory in the order book, users, you, me, when we're trading on a personal basis, we're not happy. And we go to other trading platforms. Now, why is that really an issue? Well, because for the exchange on which those order books are, they're missing out on fees. So if you're an exchange, let's say Binance or OKX or Kraken or KuCoin or whatever exchange, and for whatever reason your order book is not liquid enough, Your users, your traders, they're not going to be happy. They're not able to trade at the right price for the right amounts and so on, and they go to a competitor, to another exchange. So then you have less users and you have less people trading, and so you make less money because the core of an exchange is making money through trading fees. You want more users, or you want users to trade more, and that means they're paying more fees, and so you're earning more money. If you've understood that, you'll totally understand why market makers exist. Market makers are essentially going to morph order books so that they look more liquid, so that the markets look smoother. And actually, I think I've included, yes, a slide here to show you a chart of what liquid markets look like over time visually versus a liquid market. And again, I'd ask you, which one do you think is the more liquid chart or the more liquid market? If you've guessed the lower one, you're obviously right. There's of course a lot of ups and downs because prices move depending on market conditions and trading incentives and whatever it is. But here you can see that they move up and down in a much more jerky way in a sense, right? So every order is moving the price one step and then down again and then flat because nobody's trading in size. And so you can see here there's nothing happening, then boom, an order pushes prices down, and then here pushes prices up, and then nothing happens, and then down, and then someone bought for whatever reason in size, totally pushed the price up, and then nobody was willing to trade, and then dumped. And so those are like inefficient trades and inefficient markets where small orders are moving prices in jerky ways instead of that happening in a very smooth way. So what do market makers do to kind of resolve this? And there's a little bit of financial jargon, but you'll totally get it, I think. Market maker are essentially stepping in and posting simultaneous, meaning at the same time, two-way pricing. Two-way pricing is like an industry term, you would say, in an order book, which is to say you're posting buy orders and sell orders. You're posting bids and you're posting asks. So at the same time, you're a willing buyer and you're a willing seller. Now keep in mind, they're not actively pushing the price up or down, right? They're not taking liquidity, they're posting liquidity. So they're putting orders that are passive and saying, if someone wants to sell, I'm willing to buy. And if someone wants to buy, I'm willing to sell. And they're doing it with large enough amounts that it helps essentially with the liquidity. It helps stabilize the price because when people do want to buy, for example, and take in that sell liquidity, they're able to do so and fill their full order without plowing through the order book, without going through all the different levels because there's enough capital right there and then. And if they do it at less than if the market makers wasn't there. It also makes sure that the order book is showing a mid price that is in line with the fair market. How do they do that? Essentially, market makers are plugged into not just one exchange, but a ton of different exchanges. And so with some of the previous firms that I was working at, it would be 40 exchanges, 50 exchanges, 60, 70, even 80 different venues, where of course as a market maker, you can see all the different prices for all the different assets. And so you have a pretty good idea of what the fair price of Bitcoin or Ethereum or Cardano or Polkadot or Ripple, whatever asset is. And so you're posting very close to that mid price because you want people to start interacting with your liquidity. You want people to trade against you so that you can make money. And how do you make money as a market maker? In simple terms, you essentially, every time someone is buying from you, and so that you as a market maker, you're selling to them, you will find a cheaper price elsewhere where you can buy. And conversely, if someone wanted to sell into your liquidity, so you're buying from them, you would find somewhere else, another exchange, another venue where you can sell at a higher price. And the price differences are going to be incredibly small. So they're not really going to matter for average users like you or me when we're trading on a personal basis and we're buying 1K or 5K worth of Bitcoin. We don't care whether the price is 60,000 or 60,000.001, like decimal points. But if you're a market maker, you do that all day long, 24/7, 7 days a week, 365 days per year on thousands of transactions. And all those small decimals kind of just add up gradually. And it's very nice, of course, as a market maker, because in terms of price action, you're never really exposed. You're never risking anything based on whether prices move up or down, because all the transactions are happening in an instant. So if someone is willing to sell to you. So you're buying at 59,999 and you can sell on another platform at 60,000.01. You've made that super small decimal point difference, but that's a profit that you've done instantly. You don't care if the price of Bitcoin goes up or down because you're doing this simultaneously across different platforms, and you just keep on adding those decimal points, keep on adding those very, very small profits. Now, of course, there's a lot of things to take into account, and I'll talk about the risk and the operational, let's say, hurdles that come as a market maker. But I just wanted to show you a bit visually what they do. It looks a bit fancy and technical, but it's exactly what I've described. You have some bids, you have some passive bids here on this side of the order book, and you have some passive ask. So essentially what you're doing is you're posting at different levels amounts of assets. On the sell side, it's the asset. On the buy side, it's typically USDT or USD, whatever the quote asset is. And you're posting inventory lower down and posting inventory higher up from the mid price. And then whenever someone is going to be taking that liquidity, you will hedge it on another platform. You will arbitrage it on another platform and make those small price difference as profit over and over. Now, before I go to the next slide where I want to differentiate market makers with different trading entity, I do want to talk about the risks and the hurdles that exist when you're a market maker. Those hurdles, they're mostly operational or risk-based factors. The first one might be, for example, your internet connection. How good is it and how stable it is? Because if for whatever reason your internet connection goes down, some of the orders you wanted to hedge or some of the transactions you wanted to do or some of the liquidity you had to post to meet some kind of legal contract, you can't do that anymore. And so you might be failing on some of those aspects and losing money. The other one might be latency, which is how fast can you actually hedge those trades or post that liquidity. And if you're not fast enough, either the price have moved before you could operate in an efficient way, or maybe a competing market maker has taken the price that you wanted to take faster than you could, and so you've lost on that trade. The third one, maybe more obvious, is just the human capital and the resources cost of maintaining market making operations. Everything is based on algos, but you need people to create those algos, monitor those algos, update those algos, update with the exchanges. And you also need to look at it and adapt things over time. And all of that has a cost. And then, of course, there's the internet and the electricity cost, so the servers and just the running cost, of your machines that has to be taken into account. The other one, of course, is fees. You need to negotiate with exchanges to get the absolute best fees because every time you trade, it costs you money. And so with many exchanges, market makers can negotiate no fee trading or as low as possible in terms of fee trading. In some cases, when the exchanges really want more liquidity, they might pay the market maker every time they trade. So those are called negative fees. And so that can help, mitigate the risk, but there's still a cost actually associated with trading. Other risks that market makers might face will be operational risks. So maybe someone made a mistake when sending money or, from one exchange to the other, or maybe the delay in which assets are moved from one platform to the other to rebalance their inventory. Or maybe there's a hacking risk or a security risk, or maybe there's a counterparty risk with the exchange that you're operating on, where the exchange somehow is going down because there's a maintenance that was unplanned, or the servers are down, or there's fraudulent activity like we've seen in the past years in crypto where an exchange is actually insolvent and so on. So there's a lot of things to account for that hopefully will be offset by the amount of profit that you make on all those small transactions every second, every minute, every day. And it's kind of a tricky dance to balance the costs and the risk with the reward and the profits you're making. The last slide I wanted to talk about is the differentiation between market makers, hedge funds, and market manipulators. And the reason why I think it's important to talk about is because a lot of people kind of use those terms in some cases interchangeably, and that's typically because they don't understand what those three things do. And also in some cases, and this is what I'm alluding to, the thing that's hard is sometimes the firms engage in several activities. And so a firm might be, let's say, portrayed as a market maker, but not operating as a market maker. Or maybe a hedge fund might have some market making strategy, but not really working as like a service provider for an exchange or for a market. And so a market maker At its core, the very basic definition is what I've been explaining so far. There are illiquid order books, and market makers can add value by having a market neutral, a delta neutral positioning in those order book. They're essentially posting on either side of the order book. They don't care which way it goes, and they make small money off of the spread. And that's a very accretive and very positive effect on the space. It's good for the exchanges because the order books are more liquid. It's good for the traders because they can do their trades, more efficiently. And it's good for the market maker because they make those small profits off of those small decimal points without really impacting the price and just making sure that the prices are stable and consistent. On the other hand, there are other trading entities, like for example hedge funds, that do have a directional view on the market. So they're not necessarily trying to move the price, but they think the price will go up or the price will go down, and they want to position themselves in that way. That's a very different activity from market maker, and in some cases it might push the price up or down because the size with which they operate, so the quantity they want to buy or sell, is so big that it does have an impact on market, no matter how much liquidity there is in the order book, because the amount is so big. But presumably it will be organic. The third actor that I want to talk about is market manipulators. And market manipulators either have maybe some additional information on the exchange about the different trading flows or the amount of leverage that there is in an order book, and they will try to push prices up or down because they have a lot of capital, but they have this kind of aggressive or negative impact and view on all the other participants. So they're essentially trying to push prices down, let's say, to trigger stops, to trigger liquidation of leverage traders. So they push price down, and then people freak out and liquidations happen and stop losses get triggered. Prices go even further down, and then they can buy back at that much lower price point and push the prices back. And so they're really trying to manipulate the price, even though there's no organic or real view about the asset or about the market. Again, the tricky part is some of those firms do all those different things. They have like a prop trading arm and a market making arm, and sometimes they do engage in market manipulation. So sometimes on Twitter, you will see, oh, the market makers have done XYZ. Yeah, maybe some market making firms did engage in that behavior, but that's definitely not what a market maker should do or what a traditional market making strategy should be about. Anyway, that's it. I hope it was helpful. I'll make other videos, by the way, about market making and maybe the way they interact with exchanges and how exchanges can attract market makers on their platform. I'll also talk about how token foundations, when they're launching a token or when they have a token that is already launched, how they can engage with market makers and things to pay attention to, and many more other topics. If you're interested, please subscribe. If you enjoy the content, please like, it helps a lot. And if you have any questions, feel free to comment down below. I actually look at those and I will reply and I will try to help out. That's it. Have a great day.